Another video. Today we are going to do a usual market breakdown. Well, we'll be giving you guys a nice breakdown on the NASDAQ 100 as well as the Dow Jones and the SNP 500 and gold there as well. Now if you are new here, a sub would be appreciated as I provide valuable educational content. And if you enjoy the video, or if you have learned anything, please smash the like button to help the channel out there as well. Now before we get started with the technical data, it's important that we need to understand what fundamental data we had last week, and then obviously look at what data we can look at getting this week there as well. Now as you guys obviously know by now, we had the NFP that came through on Friday, unexpectedly giving us a higher than normal job returns, which is probably the highest since January that we saw. And again, I was forecasting it to be lower, but it came through higher, which is fine. So all we basically do now is like I always say, we just adapt to the ever-changing market environment. Now with that being said, we do understand that the data was positive. NASDAQ rose for the first straight day after the data came out, and that was good to see. The NASDAQ actually went as I anticipated. So if you remember the last breakdown that I did, I explained all of the reasons why you can expect the NASDAQ to continue higher, and we actually caught this by as well. So it's riding this wave up and then going to ride this wave to the downside once again. But before we get there, once again, so next week coming through, we have the CPI data. So the CPI data is going to be very crucial for us to see. If you're not familiar with what the CPI data is, it's basically the consumer price index, which measures the average change over time in prices paid by urban consumers for market basket of consumer goods and services. It basically measures consumer spendings. And then we've got the PPI, which is the producer price index. This is basically part of a big family of indexes that measures the average change over time in selling prices received by domestic producers of goods and services. That's basically what it does, my good friends. And then next up we do have what we call over here, which is the core retail sales. And the core retail sales represents retail sales excluding spending on automobiles, gasoline, building materials, and food services. This metric is a very strong indicator of the economic health, and is used to gauge whether the economy is contracting or expanding. Now what we are going to do is we also got the prevalent UOM, consumer sentiment. Now that basically is that just measures how optimistic consumers feel about their finances and the state of the economy. In the US, consumer spending makes up majority of the economic output as measured by the GDP. Now, that is basically the abbreviations and what they mean, so that you can understand. For those of you that has been long on this channel, probably know this by now, because I do this on a weekly basis as I do the breakdowns. So we are going to dive slightly deeper just so that we can go and understand what it is that we need to look from a technical standpoint. Firstly, it is clear here, a good big article by CNB says that big payroll gains push recession fears into the corner. That says here June's big payroll helped clear away some recession fears for an economy that could still see consecutive quarters of negative growth. Okay, there you have it. It basically means that yes, it's good to see that the labor market is doing good, but we aren't at that point yet where we see the impact of what interest rate hikes is actually going to do to the economy. Then not even to start talking about a recession. We're going to go back to what Paul had spoken about on Friday as well, and I'll give you the nitty-gritty so that you can understand exactly why I'm going to look for what it is that I will be looking for. Now it says here interest hikes and inflation they seek to control generate worry that all is far from clear for the domestic economy. So yes, the labor market's doing good, but the labor market is driven, the main contributing factor for the US economy is consumer spendings. Now it's good to see that consumers, it's very good to see that the jobs are growing, but with the continuous hike in interest rates is going to hurt consumers in the long term. And I'm not going to read too much into that. Next thing I do want to speak about very quickly is that we now know that there's almost 100% certainty that the Federal Reserve is going to hike the interest rates by another 0.75% when it comes to the July interest rate decision, which is not this week, which is next week, which is important. Why? We need to look at the CPI that's coming through on Wednesday. I said here on Wednesday, the Federal Open Market Committee released its June meeting minutes, and the Fed's language suggests that it is likely to opt for another 0.5% or 0.75% interest rate hike in July. The Fed said its rate hike could slow pace of the economic growth for a time, but warned that inflation could become intense if it does not take appropriately aggressive policy measures. Now, the Fed basically understand how this works. Now, you guys probably know this by now, right? And because I've explained this so many times, when the Federal Reserve hikes interest rates, and the reason why they do that is to bring inflation down. The reason why they hike interest rates, because this is the only tool that they can use. By hiking these interest rates, what they do is they would then slow the CPI, which is what we're getting on Wednesday. By hiking interest rates, what they do is they want to encourage consumers to spend less. As a result of that, consumer spending goes down, and as a result of that, inflation goes down with that as well. But the stock market goes down because consumers start spending less. Now, when the interest rates are lower, they're encouraging consumers to borrow more, and people are out there borrowing money, taking out loans because it's cheap, like when stuff is cheap. So demand is high because interest rates are low. As a result of that, people have a lot of money, so they can spend money on companies listed on the stock market, and as a result of that, the stock market goes up. But the way it is now, the more the Feds hike the interest rate, the more consumers are less likely to spend, and the more the stock market is going to fall to the downside. And now with a definite 0.75% interest rate hike on the boards, we can definitely expect the NASDAQ to start this consolidation phase and then probably get that continuation to the downside once we get the consumer spending data that's coming through on Wednesday. But we're going to get to the technical data side there as well. Now, it's very important to understand, if you're not aware, if you look at the US GDP, so this is basically the US gross domestic product. What this basically tells us is what it measures the annualized change in the inflation adjusted over of all goods and services produced by the economy. That is the broadcast or the broadest measure of the economy activity and the primary indicator for the economy's health. Now, we got a 1.6 in the first quarter. Now, that's the first quarter. Now, according to this GDP tracker, we can see here that the latest estimate is forecast to be at another negative 1.2%. Now, keep in mind that if you have a country that's got a negative GDP 2 quarters in a row, that normally means recession. And the way stocks normally behave throughout recession is that income and employment decline, stock prices fall as companies struggle to sustain profitability, a sign that the economy has entered through phase of a business cycle is when stock prices increase after a significant decline. Now, what we see here is that the market had basically tumbled very aggressively, and for some reason the NASDAQ is starting to find some, it's basically busy starting to find its feet. And this is a good indicator that the US is about to hit a recession. And the minute we get that announcement, basically when we get the quarter 2 GDP of minus 1.2, that is currently the estimate, you can expect the stock market to continue lower. Now, we're going to close this, my good friends. We're going to start with a technical analysis. Now, if you remember, I did a breakdown the last time, and again I've explained all of the reasons why we can expect the market to pull back to this level, and I will leave a link in the description below to the previous video that I did. Now, you can see over here on the monthly time frame, we can see how the market had printed strong resistance, broke above resistance, tested at a support did not hold. All of that support is now being tested as resistance, giving us a confirmation that there is a slight pullback expected before the continuation to the upside, which is not what I'm anticipating. There's still room to the downside for the NASDAQ 100 to move, for the market to go and potentially hit this 9,000 mark that it had created over here. Dropping down on the weekly time frame, what do we see now? From a weekly perspective, it's quite clear that this could be the start of a consolidation market. Firstly, over here, if you look left, in fact, let me go all the way left over here. Now, firstly, what we have over here is you got a market that had printed resistance, tested support, came back, broke below support, broke above resistance, broke again support. It's now testing all of that support once again as a resistance. The market had also printed the structural level here to the left. Now this level over here is currently acting as a strong level of resistance. Now this level over here acted as a strong level of support. Support got broken. The market then created this red candle next to a green candle, by definition which is structure. This level over here is acting as resistance. Now resistance is currently being tested. Now the way I can see this taking place, my good friends, is this could be the start of a consolidation that we could potentially see in the long term. However, on the daily time frame, what do we have? Now from a daily perspective, we can see the market had broken a very important structural level. This level over here acted as support, resistance, again resistance. Market broke above resistance. All of that resistance is now acting as support. The market also printed a W formation. After W formation, you expect to pull back to the neckline before that continuation to the upside. We also have a massive impulse. Now after an impulse, you expect a correction, and the best way to measure that correction is by taking your Fibonacci from the low to the high, and you can see we've got the 61.8 that's lining up perfectly with this previous level of resistance that is now acting as support. Now the best way to approach the situation is to wait for the market to pull back to this level, and then from there we could potentially start looking for long positions in the market there as well. Alternatively, if the market does however in next week do break above this level, then on the retest we can then start looking for long opportunities, but I'll get to that level once I get there, not now. So that is the way that I will be approaching this situation in the market. Next up, we do have the Dow Jones. I can see here the NFP gave us a much better jobs report than what the Dow Jones anticipated. On the Dow Jones, we can also see the market had printed a strong level of resistance. Now resistance got broken, and we can see how well support's holding over there. Now here we can also see now the market had also now is currently printing some this massive green candle to the start of the month. Now here on the weekly time frame, what do we see? Now we probably got some similar price action over here. If you look slightly left, you'll see over here that the market is also now created the structure that it currently had tested and rejected. Now if you look left, the market had also created this potential of this information. After an information, you expect the market to create a right leg. This is the left leg. Now after an information, you expect the market to print the right leg, then move to the neckline, and then expect that continuation to the downside. Now once again, because the market is currently testing previous level of the strong level of resistance, what I would expect for going into next week is for the market to start this move to the downside, then go up, and then start that rally to the downside if we do get that negative CPI data coming through there as well. Now from a daily perspective, we can see on the Dow Jones, the market also here had also not even went to go and test that previous structural level over there. So there is a slight possibility that we could see the market go and hit that level. Alternatively, we could see this first, and I'm not gonna over analyze this. So this is the first move that we are going to be looking at trading, and then I'll give you guys another update. By Wednesday, if there has been movement in the market. Next up, we do have the SNP500. The SNP500's got similar price action to the Dow Jones, so I'm going to jump straight onto the daily time frame, and we can see here we've got the same price action that was created over here, and this is also now the previous level that the market had come to test. I also have this massive impulse. After an impulse, you expect a correction, and if you take your Fibonacci from the low to the high of that impulse, as you can see, we do have a 0.50% that's lining up perfectly with this structure, which is basically a 50% pullback of this massive impulse, which is something that we always expect the market to pull back to before you see any retracement in the market. It's always expected for the stock market to pull back 50% before a continuation. Next up, we do have gold. Now gold on the monthly time frame, I spoke about gold in the week here as well. Now on the daily time frame, and the market was trading at this level over here, and I explained all of the reasons why you can see gold go lower and potentially go hit this level over here, because there was still some more room to the downside for gold to move. However, the move to the downside for gold is probably not done yet. Now a lot of retail traders, like I said, the market was at that level there, and a lot of retail traders came in to buy because that's a strong level of support. And I said the market was going to dip lower. Now there is still a big possibility for the market to dip even further low to go and test that previous level of support, especially with the positive job data that came through for the NFP, which is going to encourage even further strength for the dollar index. Now if you look here on the weekly time frame, again we have all of this liquidity over here. Now and the reason why I say that is because these are all a liquidity wicks, because the market know they've got sellers with stop losses that are at this level. All they do is they wick to the downside, grab all of that liquidity to the downside, and they call it and they call it call it what it is, my good friends. And then so this is what we have on the weekly time frame. Now on the weekly time frame we have this massive impulse to the downside, and if you take your Fibonacci from the low to the high, we do have a 0.32 pullback that's lining up very nicely with this structure in the market over here. Now there is a high possibility that we could see the pullback on gold before a further continuation to the downside. The only way to confirm this pullback, my good friends, is only if gold now needs to create some sort of structure and then break that structure. Alternatively, the price of gold will continue to move and test these lows over here as well. Now the way that I would be approaching this situation, firstly, is the market had just printed structure over here. Now this level over here is currently acting as a level of support because the market printed a red candle and a green candle over there. Now this level over here is currently acting as a level of resistance, and the best way to approach the situation is to wait for the market to break below this level of resistance, or that resistance would then be turned support. Alternatively, a clear break above this level of resistance would then be acted as support. And on the retest, we can start looking for that continuous buying opportunities to the upside there as well. Now if you enjoyed the video, please smash the like button. If you're new here, please hit that subscribe button, and as always, thank you for your time. Cheers for years.